Well, certainly, Peter, we are back, and this time around we're focusing on the property sector, and the South African Reserve Bank quarterly bulletin shows the value of new mortgage loans granted to have declined at a year-on-year rate of -7.8% in the first quarter of 2019. This after a -2% decline in the final quarter of 2018. This is the third consecutive quarter of a year-on-year decline and is reflective of a very weak economic environment. Real gross domestic product contracted in the first quarter and interest rates rose slightly last year. So what does this say about a cyclical growth turning point? We ask John Loos, who is property sector strategist at FNB Commercial Property Finance. John, welcome to our program.
Thanks, Colin.
Firstly, how's the property sector on the commercial side of things doing?
Well, yeah, if you split that overall mortgages up, the 7% decline doesn't look so bad, but if you look at residential, there was a mildly positive growth, and then you look at commercial and it was 29% down. So it would seem that the commercial sector, I would say, is better reflecting economic fundamentals. We did have that economic growth contraction. We've had this stagnation in economic growth for a few years now. And I think the commercial property lending, mortgage lending sector is just moving with it, really. It's moving with economic fundamentals, so sharply down.
It's been 3 years since the number of mortgage loans were granted, and the numbers have been going down. What's really reflecting as the push factors in that margin?
Look, I mean, okay, I've mentioned economic growth and economic contraction now as well. But, you know, go back a bit, you had, from about 2014, you had interest rate hiking as well. Mild interest rate hiking from 8.5% prime to 10.5% from 2014 to 2016 around about. So, you know, that too had a dampening role as well. And I think sentiment comes into it as well. I think in recent years, political events and policy uncertainty has impacted on the market as well. Not to a great, not that it's stopped all business, but that there's to a certain extent a wait and see approach when it comes to various type of investments as well.
Isn't it also reflective of the blow that the construction sector has really suffered in terms of investors pulling back or playing wait and see to see in terms of policy certainty how they can go about investing and whether or not to erect new buildings?
Absolutely, there's a fair bit of that. Look, new building erection is also slowed. I mean, you see, if you look at mortgage lending by application, the weakest one is for the lending for construction of new buildings. That's about 29% down year on year. Existing buildings far less of a decline. And that's typical not just because of policy uncertainty and wait and see, but also because vacancy rates are quite significant, especially in office space, but even in retail space they've been rising. So on the commercial side, no real need for that much in the way of new building. There's enough vacant space around in many areas. And on the residential side as well, you've got the household sector coming under pressure, job creation weak, disposable income growth weak, so demand for existing and new properties is fairly moderate.
But 29% decline is quite a very huge number. One would ask, when you drive around Johannesburg, you see so many new buildings under construction. Why is the number going down, whereas with the naked eye you see construction activity?
Look, I think firstly, it's quite deceptive sometimes. What you see is certain new nodes or modern nodes and prime nodes where you do see very significant construction, the Santons of the world, the Northern Durban nodes and so on. You do see quite a lot of cranes there. But that might not be reflective to all parts. There's a lot of parts of the country where you won't see that. And some of your building activity can often be a shift. So you're an existing company in an existing head office and you're moving. And that's those shifts to better locations, whatever it might be, or to consolidate your head office into one building instead of three. That can drive a significant amount of building activity, and that can also drive rising overall vacancy rates in the property sector, as you're having in office space in recent times. But overall, if you look at the national numbers, certainly building activity is not shooting the lights out, and the building sector is under significant pressure.
When it comes to the financial trends, in as far as value capital repayment, is there what one would term perhaps defaulting of some property sector owners who are not really in a position to afford at the rate which they initiated the credit extension?
Well, I suspect you are seeing some rise in the financial pressure, and you may even have mild default rises. I must say to date, I don't think the banking sector has experienced any massive deterioration in stressed loans. But it must be there. The pressures have been mounting in this weak economic environment. And at some point, if we don't get a turn in the economy for the better, you can start to see that more significant deterioration in the quality of mortgage loans.
Okay, I just want to pick your brain on this one, John, and if I'm putting you on the spot, you will let me know. But I mean, like the news that, for example, Rosebank is the most expensive rental space at the moment, the likes of Melrose Arch, even V&A Waterfront, as well as Sandton. Why is it that they're becoming more expensive, and do you think that this will actually chase out the tenants?
Well, I'm not sure to what extent they're becoming more expensive, but certainly for years these prime precincts such as Melrose Arch, such as the V&A Waterfront, and of course Sandton is almost a CBD on its own. They have been the prime areas of the country and have been some of the most expensive. I don't think that will change. That relative position would change, but if I could, through economic downturns, I think that the prime nodes are probably likely to hold up better. They will also feel economic downturns. They won't get away unscathed if these, I don't think it's possible. But I think that, when you go into an economic slump, there is always enough, there is always enough business interested in occupying space in such prime nodes. It's the marginal nodes more that are at risk, because when you get a business company moving to something like Sandton or a Melrose Arch or a northern, Schlanga, Lelucia and Durban from another more marginal node, there's often not new business coming in to replace it there. So I think that during the down cycle, it's your marginal nodes, I don't know if you'd call it subprime, but lower quality nodes that can be at greater risk. And your booms, often the prime nodes are then exploding at the seams, and it's your marginal nodes that get the upgrades, because we have to look at them because there's a lack of space. So notably, I don't think it's any coincidence that something like the Joburg CBD deteriorated in the last long stagnant phase of the economy through the 80s and early 90s, and actually got a bit of a facelift in the boom times last decade, up pre-2008. So I think prime nodes hold up better in weak economic times.
All right, John, thank you very much for an insightful analysis in the property sector.
It's a pleasure, Colin.
John Loos, property sector strategist at FNB Commercial Property Finance, and of course giving us insight of what's happening with regards to the commercial property sector in the country.